Hello, good morning and welcome to ET Now's Buy Now, Sell Now with me, Varun Hiremad, and along with me, Mubina Kapasi. With that being said, let's now get a move on and get you the headlines for this morning. The rally has paused. Nifty is trading below the 11,600 mark. There was a very flat US handover post the Fed commentary yesterday, despite them keeping interest rates low and possibly considering another stimulus bill. So the market definitely taking a bit of a drop today. We're firmly in the red, and it'll be interesting to see if we can make up lost ground over the course of the day. Then moving forward, we have an Asian Paints exclusive for you. The MD and CEO says he's witnessing pent-up demand for May really play out. Tier 2, Tier 3 and Tier 4, so not the typical metros we usually hear of, are largely insulated from COVID, and those tiers are providing higher output for Asian Paints. We then have DRL as well in focus today, surging away. The company is tied up with Sputnik for COVID drugs, and that's got that counter in focus. Then we also have a very stellar listing to discuss. Obviously, the Happiest Minds IPO, which is listed at more than 100% premium, hovering at 380 rupees versus an issue price of 150 rupees. So just an absolute amazing return, much better than the DMart and IRCTC listings. Then going forward, talking of IPOs, do we have a possible Flipkart IPO coming up soon? Flipkart officials say the company may hit D Street by early 21 and may even be mulling an overseas listing. But at this stage, it's all report-based. We're going to wait to hear more on this. Then we have Tata Steel also in focus this morning, who won't shy away to take tough calls on the Europe business as it's bleeding right now. So they're figuring out what to do, and there might be some restructuring of debt and disposal of assets there to generate some cash. And finally, as far as headlines are concerned, before Mubina gets you up to date comprehensively with the markets, former Goldman CEO David Blankfein says it's a good time to invest in commodities.
All right, well, that's of course all the big stories and headlines we are tracking for you all day on ET Now today. But of course, on Buy Now, Sell Now, we have a segment that quizzes your knowledge on the Lal Street, as well as tests whether you are adept at spotting the big trends. So here is the BNSN quiz question for the day. Which one of the following chemical companies has the highest 5-year stock price CAGR? Is it A, alkyl amines, B, Bharat Rasayan, C, fine organics, or D, Galaxy surfactants? You can, of course, take part in this quiz by tweeting to us on our Twitter handle, and the answer as well as the quiz champions for today will be revealed at 11:45 a.m. By the way, one of these stocks was also covered by Varun in our What's the Story segment on ET Now. So if you guys have been paying attention, you may get a bit of a hint, when it comes to answering the BNSN quiz question for today. But let's take a look at what the markets are up to as we speak. And, after seeing steady gains in the last couple of days, today the market is taking it a bit easy. We have a 0.25% loss for the equity markets as we slip below 11,600. 11,572 is where we are trading at, and the Sensex losing 126 points. But technology really is the cynosure of all eyes. After yesterday's momentum, today as well, it seems to be continuing as we have HCL Tech that's really putting forward a very strong uptick. Well, not a very strong uptick, but yeah, 1.6% higher. Technology really has been one pack that's shining. But apart from that, even a DRL today is standing out. Varun just highlighted what's keeping that stock active. Grasim Industries and Coal India, both unlikely movers, are gaining approximately 1% in trade. But otherwise, it's, all the other segments except for IT are losing. Starting with telecom, which is once again at the bottom of the list. Realty and metal too are the big losers. In fact, keeping it with metal, Hindalco is losing 3%, Tata Steel losing 1.8%, Tata Motors and Bajaj Auto gaining yesterday, but today more or less reversing those gains, losing roughly about 1.4 and 1.9% respectively. So that's of course about the equity markets. Remember, the Fed as well did give us some cues. They vowed to keep interest rates low, and they did say that recovery is going to be slow. So that as well is something that one should keep on their radar. But I guess, of course, Varun, the big newsmaker is Happiest Minds Technologies, a 100% premium on debut.
Right, Mabina. It's been an absolutely stellar listing for that one, and that's why it's actually featuring in the stock cloud today, which I believe our producers are just about to bring up on air. So while they do, I'm just going to talk a little bit about it. It's a very interesting issue. The promoter of this company is 77 years old, and one might wonder why he's doing an IPO at this late stage. And given his age being as high as it is, one would also imagine the leadership at Happiest Minds might change very soon if he comes into retirement. With that all being said, it doesn't matter. People aren't worried about the future of this one because the demand just seems to be very robust, firmly holding above where it's settled. The settling price this morning was 350. We're currently trading 10% nearly higher than that. So, right, Mabina, it's, one for the books. Like we said, it's already beat DMart and IRCTC, which are perhaps the two best listings we've seen in recent times. If the stock cloud is now up in front of you, let's get that going. We have HCL Tech this morning leading the cloud on increased partnership with Google for cloud services. Then we have 4 cement companies, Ambuja Cement, ACC, Ultratech and Shree Cement, all in there for the same reason because Macquarie's put out a very bullish note on cement and it seems that things are looking up for the sector. We then have a sale that's in there on the back of a brokerage upgrade as well. We have HSIL and Dhanuka that are looking at buybacks for their respective shareholders. Happiest Minds because of the listing, and then Vodafone because of their new presentation, giving out a very improved image and a lot better corporate communication from the company. Okay, I think it's now also time to bring on board our guests this morning. Kunal Batra and Ashish Kapoor are with us. Good morning, and thank you for taking out the time as always to chat with us on BNSN. Kunal, what's your high risk and low risk idea for today?
So, good morning, Varun. I'll suggest 2 buy calls. I think even at current juncture where the markets are a bit, iffy, the Bank Nifty and the Nifty are down, I think around, 0.25% odd. And I still believe that, the markets still look extremely strong to me. On the charts today is the weekly expiry day as well. So I think probably that could probably keep the markets in a bit of a volatile zone. But nevertheless, I think the direction is positive, except for what happened in the US markets in terms of late selling or late sell-off yesterday. So 2 buy calls. First is on the high risk category. It's a buy on sugar space. Dalima Sugar is a stock which I would suggest as a buy. The stock is trading at 132, 133 approximately, and I believe at current levels it looks attractive from a short to medium term upside. I've been bullish on earlier stocks from the sugar space like Balrampur Chini as well. Dalmia Sugar is the next stock which I would suggest as a buy. Targets to be kept at 140, stop loss at around 130. The second from the low risk idea, it's a buy on UPL, United Phosphorus. I think even this stock has been the surprising positive mover, steady upside on the very near term charts for UPL, and I believe with consistency of price trend, even in the tough and the volatile markets, I think UPL should do pretty well for itself. So that's also a buy. Short term targets of 550 and stop loss at 510.
Okay, thank you for that, Kunal. And Ashish, what's on your radar this morning? High risk first and then the low risk.
Well, as far as high risk is concerned, the stock which one can consider is JP Power. The stock is available at a very low valuation. The track record of the company as well as the promoters are not very encouraging, but the company is clearly on a turnaround path. And I feel at this price, the risk reward is very favorable. The company's main problem has been the huge debt which they are carrying. The company otherwise at operational level is doing fairly well because all their power plants are now operational and doing fairly well. What is holding back the company and making losses is the huge debt which they have. Now, what is encouraging in this company is that they are going through a restructuring of the loan process with ICICI. The restructuring process is going on fairly well. And also what is encouraging is the GSW Energy has picked up a stake of 10% in this company, which gives us the possibility of getting another promoter in this company at some stage. On both the counts, on restructuring as well as the JSW Energy putting in money in this company, we feel the company has a fairly good chance of turning around. And at the current price, the risk reward is very favorable because like I said, the power plants are all doing well. And if the company is able to reduce its debt and reduce the interest burden, the turnaround can be very significant, and the upside from here can be very huge. We have a target of 10 rupees. It is of course a little high risk call because still the company has not turned around, but the risk reward is clearly very favorable. So if you have a penchant for risk and you're ready to take a chance, then buy this stock. The target is 10 rupees, and the downside risk is obviously minimal because the stock is trading only at about 2.75 to 3 rupees. The low risk ideas are two. One is Max Healthcare. Now, Max Healthcare, the turnaround is very significant because the original promoters have moved out of the company. Now, company is now being managed by a group of private equity investors led by very marquee names like KKR. The company has appointed Abhay Soi, who is a turnaround of hospital specialist, as their CEO. So there is a fairly good chance that the company going ahead will do well, as the hospital sector in India is set to see a very good traction going forward. The company also has a very good presence in both the metros after taking over Nanavati Hospital in Mumbai and B.L. Kapoor Memorial Hospital in Delhi. The presence is fairly significant in various other cities in North India at least, and the company has drawn out a good plan of expansion in other parts of the country. So altogether, this is a very low risk idea because currently the valuations are not expensive. The growth in the industry as well as in the stock is clearly visible going forward, and with Abhay Soi as the head, I think that we can expect a very good growth in earnings and visibility of growth going forward. And with the various private equity players as the holder in this company, the clear focus on profitability and growth should remain. So this is one idea. The other idea is other low risk idea is IEX, Indian Energy Exchange. Now this is a kind of still a nascent concept in India, but growth potential is huge because the exchanges are doing very well in Europe and other places of the developed world. Here it is still a very small part of the total power consumption, but going forward we are fairly confident that this segment will increase. Also, power consumption as a whole is also going up in India. The company has a first mover advantage plus also a very good significant lead. They have about 95% of the market share in energy exchange in India. And the technology platform which they have created is very well accepted and has a lot of advantage over other peers. So with a very good management in place and a good technology platform and a clear first mover advantage and a very high market share of a segment which is definitely going to grow, because as the power purchase agreements start getting terminated, more and more energy demand will get shifted to short-term contracts, which will be traded through the exchange. So this is another very good stock idea. The very immediate 1 year target is 250, but one can clearly buy this with a long-term perspective, very low downside risk, and upside potential is huge. So these are my two low-risk ideas, and the high-risk idea is JP Power, which I explained earlier.
All right. Ashish, I just wanted to get in a view from you on Happiest Minds. Everyone's been talking about the Ashok Soota magic, really, and if it will work this time around. Well, if we just have to purely look at the way it's listed, it looks like it definitely has. And subscription numbers as well were great. Do you have a view on Happiest Minds?
Well, I certainly believe that technology is a good space to be in, and Ashok Soota does inspire a lot of confidence. Other than that, I'll confess I haven't tracked this stock. It just got listed, so I won't be able to comment on it particularly.
Okay, fair enough, Ashish. No worries there. I'm sure we'll be catching up with Happiest Minds later on at some point today. But let's move on to the queries in that case. And the first one is from Sandesh Parab of Jaipur. And he's bought 2,000 shares of Aegis Logistics at 240 rupees. And it's been 8 months for him now with barely any return or no returns. Should I sell out or hold on? So Kunal, let's pull you up first in the chart. I know Aegis is something that we talked about recently. There's also been some brokerage upgrades, but for a year, Sandesh hasn't really made any money. So at this juncture, does the chart indicate that there could be some further correction, or should he just stay put?
I think you should stay put. I think the charts, even though the stock has not done anything in the last 1 year, but then it's not just with respect to this stock. I think it's with respect to many of the stocks which have been showing signs of first strength in the late 2019s, going through correction in the start of 2020, and then now trying to go into a recovery phase. So I think it's natural that many of these stocks have just about gone to a break-even mode compared to a year-on-year basis in terms of price performance. But then you have to look at it in the context of how strong the stock has shown a recovery. Now that, I believe, is a hallmark of any kind of a stock which you're looking at. So especially the mid-cap and the quality mid-cap names and the large-cap ones, of course. So now look at it this way: in the last I would say last 10-12 months, Aegis Logistics or Aegis Chemicals, as the code go by, was at 240 levels. It corrected back to almost sub 100 or just about that 100 odd mark, and from 100 the stock is now back at 240, 245 levels. So it's a very sharp recovery which you've seen for Aegis Logistics in the last 6 months. Now that kind of a recovery itself tells you that the bounce back has been very sharp and very fierce, for the stock from those bottom levels. And I think I for one believe that that's a very strong and a positive sign for the medium to long term charts. Look at this historically as well. So let's talk about, say, the period of 2014 to 2018. The stock had done exceptionally well. I think in that period, I think if I'm not wrong, the stock was at 10-12 rupees odd, and it had moved to a level of 270, 280. So in a matter of just 4-5 years, the stock had given returns of almost 25-28x in a matter of 4-5 years, and then went through a consolidation. So these are phases, and these are times where traders and especially long-term investors rather have to have patience into these kind of names. You don't expect that these stocks which have gone and given you returns of 10x, 20x kind of returns to try and keep on performing in a very similar kind of a manner every now and then. There will be periods of long consolidation, and you have to ride those periods with utmost degree of patience. So I believe, for one, Aegis Logistics is a good stock. We should hold on to it, and don't be impatient. Hold on for the next, I think, few years more, and I believe that a strong potential upside should be visible for the stock.
Okay, thanks for that, Kunal. And Ashish, to get a fundamental view, I'm just looking at Aegis's numbers right now. In 2009 and 10, revenues were 300 crore. Today, as of FY20, they were 7,000 crore. During that same time, the EBITDA has gone from some 50 odd crore to 300 crore in FY20. So these numbers are really impressive and show great execution. So do you think this company is fundamentally going to do well going forward as well?
Yeah, certainly it will. And you rightly pointed out, the company has a great track record of growth as well as investor wealth creation. So currently the investor is getting impatient, and I understand that, because the stock hasn't done anything for the last almost a year, and in fact last few months it has been going down. The clear reason is because the company is the leader in oil and gas and chemicals logistics. That sector is certainly not doing well. National trade has suffered a lot because of COVID, and also oil prices have really come down. But given the fact that the company enjoys clear leadership position in this segment, and also we do not expect these low prices to remain forever, at some stage the oil prices will also start moving up, and the national trade will also pick up. So I think eventually this stock will come out of its blues and will start doing very well. It's just a question of holding on. So I have a clear hold on this stock. Do not get impatient. It has been underperforming for some time now, but I think that will clearly change once the situation on COVID improves, and once the crude prices start inching higher. It's difficult to time it, but I think if you hold on for another 6-8 months or maybe 1 year, I think you should not only get your money back, you should also make a profit on this. And if you can hold it for a longer period, maybe 3 to 5 years, this clearly is a stock worth having in your portfolio and should give you very good returns going forward.
All right, that's of course Aegis Logistics for you. Let's take on board our next question from Vinod Malche, Cochin. He writes in saying he bought 500 shares of PVR at 1800 rupees per share in December. That's precisely before the COVID crisis hit India. Now he wants to know if he should sell, if he should add more to his existing, holdings, or if he should just simply hold on. Well, for now, we don't know anything about when these multiplexes will open. We just know that they have been suffering huge losses on account of, zero revenues coming in from the theatre business. But Kunal, let's first take a look at the technicals. What's your view on a PVR?
Well, yeah, I think a lot of question mark, frankly, Mubina, that, when the multiplexes will open up and how if effective and efficient will the opening up of the multiplexes happen, because I'm very sure that a lot of the spaces across across India would probably be be more circumspect of trying to go full hog into the multiplexes at a time when the vaccine or the viruses are or the spread of the viruses is at almost its peak. So I think, yes, there is a lot of question mark. Now, purely basing my view on price performance, I think the last 6 months of the price recovery which you've seen, there has been a late start towards the price movement of the recovery for PVR. So at a time when many of these stocks they apparently bottomed out in the month of March, end of March or start of April somewhere, PVR was the stock which actually bottomed out at the start of the month of May. So there has already been a late starting approach for the stock price. Now that generally happens when there is not too much of a confidence, but because the entire market has moved up, you will have all these lagging out stocks or the laggard kind of a stocks. They will also participate in some way or the other in some phase of the market or the other. So that itself tells you that it's not a stock which has been liked quite quite evidently by the markets because of its late start approach in this last 6-7 months of price recovery. Then you look at the price performance of current juncture, that from 1450 levels, the stock has easily corrected towards the 1200 level. So it's now at a very crucial support. So I believe 1150 to 1200 zone is a very, very important zone for PVR in terms of support. If there is any major breach and a break of these key support zone, then I believe that a possibility of a full-blown reversal on the downside could probably happen for PVR. So I would say wait and watch, but keep an eye on this 1150 to 1200 zone. If this level gets breached, then I believe that that should probably trigger a lot of stop losses, and I think you should also have a stop loss very close to that kind of a range for PVR.
Right. Ashish, what about you? I mean, I think this is purely going to be an event-based talk, really, of when the government will allow multiplexes to open.
Well, I think given the fact that nearly everything has opened now, even metros are running, and even gyms have been allowed to open. I think it's just a matter of time when cinema halls will also get the permission. Now, yes, one has to look forward. So on PVR, one can say that a large part of the pain is really behind us, because for the last 6 months, all cinema halls have been closed. The stock did react very badly, and it was not surprising because they had zero business. They still have zero business in their company. But at some stage, cinema halls are bound to open, and given the fact that we are at the end of the day a very social race, and cinema viewing is never going to go out of fashion. With some innovation and some precautions, even cinema viewing will start, and I think it will now start sooner than later. So with a large part of the pain behind us, it doesn't make any sense to now consider booking out of this stock. You have anyway weathered it for the last 6 months, so kindly weather it for some more time. The company is the clear leader when it comes to cinema exhibition, and has a very strong presence, as company has been doing also very well till the time COVID crisis happened. So whenever normalcy comes back, the company will resume on its growth trajectory. There is no doubt about it. Timing can be an issue, could take a little longer than expected to come back on the growth trajectory. But clearly, my advice would be to hold on. The company otherwise is very strong on fundamentals, and I am very sure that at some stage we all will again start going back to cinema halls, regardless of whatever time it may take to get out of this COVID crisis, because we are wired to be social, and this is something which we cannot hold on for long. And this company being the clear leader, in fact, at lower levels, it was a good buying opportunity. It has recovered from the low levels, so I wouldn't suggest new buying, but clearly hold on to your investments and be patient. At some stage, you should get your money back and also make good profits on this.
Okay, thanks for that, Ashish. So you seem quite upbeat on a PVR, and understandably so. But on to the next one. We have Westlife in focus. Raju Sheth from Surat has written to us, I bought 1,000 shares of Westlife at 430 rupees in February. As it has now recovered, should I sell or continue to hold? So, Kunal, purely looking at the chart, what's your advice for Raju?
Yeah, I think it's an interesting chart, Varun, and I think in the last 5-6 months, the stock has shown some good degree of price trend. So even though it's not a flashy kind of a stock, which tends to move up 10, 15, 20% in a short span of time and sees a follow through price action, it's more of a laborious move for Westlife in terms of price performance. But nevertheless, the trends are quite stable, quite intact. Now, if you've bought at 440 odd levels, say around 7-8 months back, and the stock is very close to those kind of levels, I believe you can look to hold on to it. And I would sense that now the support zone for Westlife is closer to this 200-day moving average, which I think is placed at 360 or 370 zone, on the spot level. So I think that's a strong support zone for Westlife. My sense is that possible that the stock may correct from here, come back to a 370-ish kind of levels, try and consolidate over here before it tries to pick up trend yet again. So if you're a patient investor, then I believe that you can use the zone of 370 or 360 as a zone to average out further, try to bring your cost price lower, and then try and take use of the subsequent price uptrend. If not, then I believe what you can also do is you can look to exit some of your holdings or major of your holdings over here, and then look to buy back again when the stock comes back to that 370 level. That could also average out or reduce your cost price by a significant amount of margin. So it depends on the appetite of the investor. If you're a long-term investor, then I believe you should stay put, and I think you should look to average if the stock comes back to the 350, 370 zone.
Okay, thanks for that, Kunal. Ashish, what's your take on McDonald's and fundamentally speaking, of course?
Yeah, the company is the master franchisee of McDonald's in Western and Southern India. And clearly, of course, the company has not been doing well lately because it's pretty obvious that very few people are dining out. But the good thing is that the QSR segment is coming back very strongly. And the company also has taken various initiatives to innovate and help in the dining out experience. Companies otherwise fundamentals are very strong in terms of operating margins, in terms of expansion plans. The company does inspire a lot of confidence. They have put their fresh expansion plans on hold, but the company hopes to come back on the original growth trajectory path very fast. And I think given the fact that QSR is something which will continue growing very rapidly in India, and the company still is available at a significant discount to the other QSR player, which is Jubilant Foodwork. I think clearly this is a company worth holding on, if not buying at these rates. So my advice would be to stay put, and I think most of the pain is now behind us, and as we move forward, especially the QSR segment is seeing good traction, so we should see a good amount of recovery in the stock price very soon.
All right, so that's of course the recommendation coming in on Westlife. Ashish definitely very optimistic. Gentlemen, on that note, we let you go. Thanks so much for joining us on today's episode of Buy Now, Sell Now and helping our viewers out with their queries. We will take a very short break on the show, but when we return, we will be chatting with the management of Happiest Minds. That's the stock that's of course listed at a 100% premium. That's doubling money for all the IPO subscribers. So what exactly is the secret sauce? We will be chatting with the man himself, Ashok Soota. So stay tuned. Hi everyone and welcome back. You're watching Buy Now, Sell Now. Reminder for all our viewers, we have the BNSN quiz for today. The question that we've asked you is which of the following chemical companies has delivered the highest 5-year CAGR in terms of stock movement? Is it Alkyl Amines, Bharat Rasayan, Fine Organics or Galaxy Surfactants? Quickly tweet to us the correct answer and we will reveal who the BNSN quiz champions for today's quiz are at 11:45 a.m. Well, earlier in the day, we spoke to market veteran and a very rare voice on television, Nilesh Surana, the CIO of Mirae Asset, who remains optimistic of the two sectors that have really been the cynosure of all eyes, IT and pharma, in the long run. Listen in.
No, Nikon, both have different dynamics, and to that extent, it is not that they are correlated in terms of why they are holding on and moving up. I think if I have to, let's say, quickly look at IT, clearly what has happened is because of the pandemic on the demand generation side, we have seen steady improvement in deal closures across segment because enterprises across sectors are embracing digital. This entire digital piece has been a game changer, and that would mean an acceleration of IT investments. And also commendable work on the demand fulfillment side in the IT sector. In the technology sector is actually benefiting from higher offshoring given the adoption of remote working. This work from home concept is actually, I mean, it would not have been done otherwise. So that along with savings, let's say from travel and rent, these are helping the margin side. So overall, there has been tailwind in the IT sector, both on account of demand coupled with margin resilience. So that has been on the IT side. On the pharma side, of course, different reasons have been there. Again, it's been another COVID-proof sort of sector. I think one thing is, the base was favorable. I mean, people, if you remember 1 year back, pharma stocks were not doing well. Our own pharma fund is up 50% in last 1 year because the base was low. It was going through a bad patch. On that, there were 2-3 things. I mean, one is inherently healthcare business has structural growth drivers, both on the domestic and export markets. I mean, on the domestic market, it is much more secular and it is driven by increasing health spend in India. And particularly the positive rub-through of the pandemic on the pharma sector has been, it has provided an opportunity for India to be counted among preferred alternate hub for pharma products. I mean, be it APIs, key supply materials, formulation, etc. So that has only strengthened the India advantage, India chemistry advantage on that. In addition to that, there has been a recovery in the US generics. So multiple factors has led to outperformance in pharma. I mean, both the factors are different. I think both are very strong, longer term secular growth businesses. And we are positive on that. That said, of course, because pharma has moved too fast too soon, one has to, let's say, particularly on the sectoral fund, one has to be much more, put money more through a SIP route rather than a committing lump sum.
Okay, that was, of course, Nilesh Surana. But on to the Happiest Minds IPO. We're now joined by the promoter, very special management, Mr. Ashok Soota. Thank you so much for taking out the time to talk to ET now, sir. Congratulations, firstly, on a stellar listing. We've seen a very strong response from investors, over 100% gains on listing day alone. How does it feel, and what's the way forward for the company post this very strong listing?
All of the people who helped to make the IPO successful, and that obviously includes our bankers, our legal counsel, our auditors, our board members, and of course, mostly our wonderful team, to whom I'd like to dedicate this IPO. And now, in terms of how it feels, I do have one little mixed feeling here, I must tell you. See, from the moment we've had this huge response, there's always this feeling of saying that they're going to be disappointed people who applied and didn't get their shares. And you can see this from social media comments, etc., of people who are disappointed. Second aspect is that it, of course, creates a responsibility on the teams to be able to deliver on the expectations that it creates. And to that extent, it's a challenge. And of course, it's a challenge which is something that we must look forward to and see how we move forward in our journey from there.
Right, Mr. Soota. And you know, the mega trend post-COVID, at least us here at ET now, that's really becoming apparent, is that there's been a mass acceleration in the adoption of technology. Now, you have 97% revenues coming from IT services, and a lot of it is digital. So at the industry level, what's the kind of opportunity for an IT services company like yours? And how much of this can you potentially capture in the near term or next 2 to 3 years?
I should clarify and make a distinction between what you call as a broader IT services market and the digital part of the IT services market. So we as a company, when we say we are born digital, born agile, 97% of our business comes from digital. And the traditional IT market is growing much smaller, which is why we're able to grow at a faster rate, say a compounded of 20+%, as compared to about 8% to 10% for the larger IT players today. And I would imagine that when you said again that the IT services business is growing, yes, it is. The entire market, typically in slowdowns and recessions, and more so in this one, where everything is becoming virtual, then IT will definitely grow faster. Within that, the transformation towards digital will also get accelerated. So from that angle, I'd say we're in a nice spot.
Okay, well, Mr. Suta, this is Mubina as well joining in, and congratulations on the stellar debut. Now, you're primarily into IT services. Is there any plan to perhaps expand into other verticals, or would it be sort of limited to verticals that are similar to the ones that you're currently present in?
We should be clear that we are an IT services company. We are not in any other business, and neither do we plan to get into those businesses. But when you talk of verticals, see, the way we define and the whole industry defines verticals. For example, our largest and fastest growing vertical is edutech. You can clearly see how that's going to benefit even further in this environment, because everything is becoming virtual. The other vertical in which we've got a very strong presence is the rest of the high-tech world. Again, because it's a core competence at Happiest Minds. Between the two of them, they account for 42% of our business. 76% of our business is coming from verticals which have been only marginally impacted or not impacted due to this COVID situation. So from that angle, we're in a good position to build on the strengths. The other 24%, yes, they have been affected. But fortunately, again, we've got a very marginal presence, for example, in travel and hospitality, which is the worst impacted vertical. And therefore, what we've now got to do is to continue to build on the strengths that we are in. We believe we've got a pretty broad coverage in terms of vertical. So it's not that we are planning to get into any new areas, but the key thing in Happiest Minds, which distinguishes us, is the fact that we're always investing in new technologies. And then we build solutions and solution accelerators to get into those markets. And I'll give you one example here. When we began Happiest Minds, we were in what was called as the SMAC stack, which included analytics and cloud. After that, we have added over the years the Internet of Things, we've added machine learning, we've added virtual and augmented reality, and so on.
Okay, Mr. Venkat, we've seen margins improving in the recent quarter. How do you see margins trend over the next 2 or 3 years? And also, are you seeing any kind of pressure on the pricing front post-COVID?
So FY20, we ended the year with EBITDA margins of about 16%. Now, if you look at it, the fourth quarter of FY20, we had already touched numbers ranging between 18 to 19% of EBITDA. So what you see of 16% is for the year. From that point, quarter one, we ended with about 26% EBITDA. Now, I should give you a little bit of a background to the first quarter jump. We had quite a bit of tailwinds or upsides from some one-time reversals, and also the foreign currency situation that the rupee depreciated quite sharply vis-a-vis dollar. That added to the profits. So if you look at it, without giving you forward-looking kind of a statement, I would say that we could model our EBITDA to be between 21 to 22%. That's the kind of number that we've been talking about. But for Q1, given these one-time write-backs and the foreign currency situation, we ended up with about 26%. EBITDA. So that's on the margin front. As far as you're looking at the pricing pressure from competition or from the markets, we are not seeing that in our case. Like Ashok mentioned earlier, 76% of the verticals that we are focused on really have not been impacted that much by COVID. In fact, we are seeing spends returning into them, and they are seeing growth. We are seeing them growing with us. So to that extent, we are not seeing too much of pricing pressure.
Right, Mr. Venkat, 76% of your business being insulated from COVID is definitely an encouraging metric. But, you know, coming back to the revenue growth historically, the CAGR has been 20%. So this is far higher than other IT companies. And while we've now understood that you're digital and not a traditional IT services company, can this CAGR ever be more than 20%, or have we pretty much maxed out now?
The mid-sized companies are growing between 8 to 10%, Poonam, over the last 2-3 years. So like Ashok had earlier mentioned, the part of the IT services business that we are focused on is the digital IT services business. So to just differentiate, if I say that there are two parts to the IT services business, one legacy and the other digital, the digital part of the business is seeing 20+% growth when you take a look at the industry growth numbers. So to that extent, our growth is in line with those numbers of 20%, whereas the other mid-size, be it large mid-size companies or the small-size companies, have been seeing growth in the range of 8 to 12% over the last couple of years.
Right, Mr. Venkat, thanks. So it seems that we're going to be playing around the 20% growth rate kind of ballpark. But coming back to you, Mr. Soota, you know, your stake has come down post the listing. Are there any plans to reduce the stake further from current levels? Also, you founded Happiest Minds and got it listed. Earlier, you founded Mindtree and got it listed. Could you share your interests in other ventures or plans ahead?
First thing I must tell you is, in terms of my own stake, after the dilution which takes place here, and I think, Venkat, that's open data, so I can say that. Right. So it'll be 55%. But then remember that we've got a very large proportion of our shares also held by our team members. So if you've got a question at the back of your mind as whether there could be a hostile takeover because you brought in Mindtree, etc. also, all I have to tell you is that there's no such threat. And there will never be, for that matter. So we will keep ourselves well positioned as far as that is concerned. Forward, again, I don't want to speculate on whether my shares will go up or go down. If we raise more equity, obviously, there's no immediate plans to do so. Whatever happens, we will keep certainly one thing in mind, that there will never be a threat to, in a sense, ownership, which could help and create a situation of a hostile acquisition.
All right, well, Mr. Soota and Mr. Venkat, thank you so much for joining us today, and congratulations once again on a great first day on the Lal Street for Happiest Minds. Well, it's also a great day for ET Now, because yet again, ET Now has emerged as the most watched English business news channel in India. So viewers, thank you so much for continuing to place your faith in ET Now to get you the best, most unbiased and fastest analysis of all the latest news and updates. And to reveal what our BNSN quiz questions answer is, as well as, of course, who are the BNSN champions of today. The question we asked you was that which one of the chemical companies has the highest 5-year stock price CAGR. The options we put before you were Alkyl Amines, Bharat Rasayan, Fine Organics and Galaxy Surfactants. So for all our loyal viewers of ET Now, had already dropped a hint, and I had told you about how Varun had actually discussed this stock in his What's the Story segment, and the answer is Alkyl Amines. So it's no wonder that we have got quite a few winners today. Our three winners are Ravs, who can be found on Twitter at Ravs55149918. We have Saloni Investments as well, and Chetali Kenny. So congratulations to all three of you for not only emerging as BNSN's quiz champions, but also one of the most loyal viewers of ET Now.
Hello and welcome back to Buy Now, Sell Now. Let's get you an interesting excerpt from a conversation Mobina had earlier. Amid the low interest rate regime, how should senior citizens go about investing their money? Listen into one of the top wealth advisors, Hemant Rastogi of Wise Invest Advisors Portfolio Cues. Listen in.
Two very important options that senior citizen can actually consider. One is the senior citizen savings scheme, which currently offers around 7.4%. Which is payable on a quarterly basis. And the second is the Prime Minister Vay Vandana Yojana, which is actually managed by LIC. That also offers 7.4%. Again, there is an option to get the return either on a monthly basis, quarterly basis, half-yearly basis, or on an annual basis. So if you were to really compare what these two options are offering today, as compared to FD, these are certainly the better option. Second thing, like I mentioned earlier, again, the important thing is to make sure that the portfolio value also grows. You're not only looking at, fulfilling the requirement of your regular income, you want your money to grow even as a senior citizen. So the focus has to be at least put some money in options, the market link products of maybe mutual funds that have the option to give you higher return and maybe help you in kind of getting a positive real rate of return. Considering that safety is of paramount importance for any senior citizen, they can begin with looking at hybrid funds.
Okay, well, you can catch a brand new episode of The Money Show today at 5 p.m. We'll be talking about ETFs. As you know, despite whatever has been happening, in terms of outflows in other equity mutual funds, it's this category of ETFs where there have been net inflows for the last 4 months. So stay tuned to ET Now. For now, we'll wrap it up. Thanks for watching.